Welcome to another edition of Zacks Rank Buy. I am Brian Bolin, and I am the aggressive growth stock strategist here at Zacks. And I've got two more stocks for your aggressive growth radar screen. So let's get right to it. Are you hungry? I hope so. I did something with food not too long ago, but I'm going to do two restaurants here. We're going to do Wingstop. WING is the ticker. It's a Zacks Rank number one. That's a strong buy. A for growth, F for value. And I searched specifically for A's with growth and F's with value because I want to have stocks that have that setup. And that setup means to me that we are on the right path looking for growth things, because growth investors and value investors are inherently looking for different things. All right, so here's the chart. We see a little beat right here, and then a nice dip and post earnings drift higher, but then a little bit of a collapse here into July. It's an $11 billion company, pays a little dividend, just a small little dividend, 0.2%. Let's check out our numbers, what we always go to see. Are you beating the number? They're beating it. They're beating it. They're beating it. They're beating it. Importantly, we see on the absolute basis here, besides a little fall off here towards the end of the year, but aggressively higher there for 98 cents in the most recent earnings. That should translate to higher earnings estimates, and it does. 78 cents moving up to 81 cents, 85 cents moving up to 87 cents. For the full year, 339 up to 346. For next year, 414 up to 424. Estimates looking good here. Here's the key. It's sales, gigantic sales growth, 28.8%, almost 600 million. And next year going almost to 700 million. Growth's going to slow a little bit. That could be a worrisome factor down the road. And why is that a worrisome factor? Is because your earnings, you're really paying up here 110 times earnings. You do have that 34% top line growth rate. That's great. And A for book value. So that's why you're looking like a negative number here. That's why your value investors are not going to like this stock. But margins 16% up to 17%. As those margins move higher while there's sales growth, that means earnings growth is going to happen. So good to see there. If we take a look at the chart, this thing has just exploded. Here we're all going to die in the pandemic. We come back. It's that tech wreck of 2022. No big deal. And it's just been off to the races higher in the midst of an inflationary environment. Chicken prices have soared over the last few years, but that's pushed the consumer into Wingstop, or what they view as cheaper food. But you can see the earnings estimate lines, especially here, just big growth there in 26. That's going to support that for a little while, but it is highly valued. All right, so that's Wingstop, WING is the ticker. Let's move on to our next one. It's Cava Group. Cava Group, the Mediterranean style restaurant. CAVA is our ticker. It's a Zacks rank number one strong buy. A growth, F value, as I said. Same sort of setup here. We had the beat, a little bit of a drift higher, but coming back in, half the size of Wingstop at $9 billion in market cap. All right, so it's Cava, it's Mediterranean restaurants. Let's check a look at our numbers. Outstandingly huge beat. Another huge beat. Another huge beat. Another huge beat. This one is the miraculous sort of stuff. 21 cents when 3-cent loss is expected. Still expecting a loss, but you come in with a profit. You have a profit, you double the size of the profit. You're expecting 4 cents and you triple that. That is great to see. Good earnings there, good earnings momentum. How are the estimates doing, Brian? Well, I'm glad you asked. That's what Zacks is all about. Well, the estimates are holding still for this quarter, for next, but for the full year, going from 25 cents to 34 cents. And next year going 34 to 46. So we're happy to see that. Not quite as good as Wingstop. Let's take a look at our top line. We're looking at 24% this year, slowing down and crushing that $1 billion threshold. But 20% is still a very respectable number, and it's a long ways off. Things can change between now and then. All right, our valuation, we're looking at sky high numbers here, 233 times forward estimates with 27% growth and a 15 times book multiple. Those are all very difficult numbers to swallow, even if the food is great, even if it's very tasty. And that's what I hear about the Cava Group. Very, very flavorful. Margins are awfully thin here, 1.8 to 3.75, but growing. And if you're growing, that's going to be good because margins up, sales up means earnings up. Let's take a look at this. Came in after its IPO, but it has been a rocket ship ride higher up to 90, coming back into that 80. And these estimates just keep on moving up, keep on moving up. So for the foreseeable future, things are looking good for both of these stocks, restaurants, Cava and Wingstop. And, but there's also danger there. They are highly valued. So if there's very bad things, these stocks will get murdered. But for right now, the consumer is obviously looking at all their options and looking at chicken prices. That's a big part of these two companies. So look for that going forward. Okay, that's it for this week. Be sure to join me next week when I've got two more stocks for your aggressive growth radar screen. But until then, why don't you go to Zacks.com/promo to check out all of our latest promotions.